So March is coming to an end. I spent over 100 hours either in front of the charts or learning about the charts, back testing. I spent 100 hours this month of actually doing this stuff. And I've learned a ton. So I just basically want to just give you a real quick recap of all the most important things I've learned this month, just about trading and just really ICT in general. So first things first I learned is journal everything. I'm talking about everything. And by the way, too, what I'm gonna do is I'm gonna talk about the stuff I learned, and then in the middle of the video, I'm gonna show you how all this stuff actually looks like on the charts. So first things first, and then it's just journal everything. I'm telling you, I started journaling, I wanna say towards the mid-February. Yeah, because it's March, so February. Mid-February, I started journaling. It's been a complete game changer because I never realized how much progress I was making until I looked back and I could see on February 15th, I was struggling with this, like X, Y, and Z. So for example, we'll just say in February 15th, I was struggling with order blocks, and now I can see an order block with my naked eye. I look at the chart, see the order block instantly. So what I would say is journal number one, because you can see how you're getting better. And also too, it really allows you to become aware of what you're actually struggling with. And then after you start to become aware of what you're struggling with, you can spend more time on it and thus get better at it. Now this is gonna pretty much be the only long-winded answer, so just so you know. And then from there, I learned about volume balances, balanced price ranges, the relationship between fair value gaps and volume balances. Dude, this was a freaking game changer. When I heard about this, I was like, wait a minute. You mean to tell me all these times, the reason why I was not getting out of trading at the correct time or getting in trades at the wrong time was because I didn't know that a fair value gap and a volume imbalance actually go together. Trust me, your mind might be blown right now, but just wait till you see the charts. It's insanity. Now, don't worry, I'm getting really excited. Then from there, we got order blocks, breaker blocks, and mitigation blocks. Not gonna lie, order blocks, I'm amazing at. Breaker blocks, okay, I'm all right. And then mitigation blocks are something I definitely need to practice more. I'm still struggling with them. I can see it after the fact, but as it's forming, I won't notice until I go back and look at it later. So I need to definitely get better at mitigation blocks. I'm just gonna get better at that just by doing more back testing of literally just looking for mitigation blocks. By the way, if you don't know, I'm also gonna explain this later. Basically, a mitigation block is just an order block that failed. And a breaker block is just an order block that was inverted. So I'm also gonna show you that stuff in the chart, so don't worry. And then from there, we then have macros. Oh man. We also have the new day opening gaps. I tell you, new day opening gaps, new week opening gaps, and session gaps from 4:14 a.m. to close, from 9:30 a.m. close. The new week opening gap and the new day opening gap is the most insane thing I've ever learned about trading. Dude, I'm not kidding you. I'm gonna show you this shit. You're gonna go on the charts after you're watching this video, and you're gonna look for literally just the new week opening gap, and then you're just gonna look at how price gets sucked to that thing like a magnet. It's insane. It's like a black hole. So I cannot even wait to show you guys. It's so crazy. Then from there, we then have, this is another great one, macros. I kind of touched on this. Basically a macro, the algorithm, is it real, is it not? I don't know, but it works, so I have to say. So let's just say the algorithm, right, is number one in New York time. And macros, you can literally go in your charts. There tends to be the most volatility. That means like there's the most amount of, big moves during macros. So macros, number one, if you gotta look into little things a bit like kill zones. So for example, we're just looking at the New York session from 9:30 to 12 p.m. I'm sorry, to 12 p.m. is the New York time. Then after that, from 12 to 1:30, we then have New York lunch. And then from 1:30 to 4, we then have the afternoon kill zone. So with that being said, by the way, this is on indices to be clear, like so futures. So with that being said, it's crazy because if you were to look at that time zone, every single hour has a macro. So macro is just the first 10 minutes and the last 10 minutes of every single hour. And so I'm gonna show you this stuff later, but if you guys are just gonna notice, during the macros, that's when there's the most volatility in the markets, and that's when you tend to see these big moves. So for example, in the macro I trade the most is 9:45. It's technically, 9:50. So 9:50 to 10:10. That macro, oh my goodness, it's beautiful. So I literally only take trades in those time periods, and then from there we then have the uh, macros are crazy, and then from there we then have the 9:30 fair value gap. Guys, I'm about to blow your mind. Every single day at 9:30, specifically. Also, when I say 9:30 fair value gap, the fair value gap is not at 9:30. It can be as soon as 9:31 and after. But basically, so as soon as it hits 9:30, after that, you're gonna have a fair value gap that's gonna form on the 1 minute, and then you're then gonna take that fair value gap and just draw it out for the rest of the day, like just extend it fully to the right, and just watch how price keeps on. It will go up, come right back down the fair value gap, go up, go right back down that fair value gap. Now, obviously, there's more to it than that. I'm making this sound very simple. It is a little bit more complicated, but and then from there, we have SMTs, which is just a smart money tool. SMTs are something I recently learned, but they're insane because essentially you can basically tell with an SMT when the market is most likely going to change. Now, to be clear here, you still do need to have a higher time frame bias, just to be 100% clear there. But so there's that. And honestly, I learned pretty much all this stuff from, like I mentioned, the king of all this stuff, the mentor of your mentor, the notorious ICT. Can he trade? Can he not trade? I don't know. I don't care. All I know is this stuff works for me. So take that with how you like. But ICT concepts are king. And then from there, too, I've been watching ICT now for the past couple months. And it's been really hard for me to understand Michael. That's ICT. Just because obviously he is the best teacher compared to anybody else, but his stuff it's sometimes hard for me to understand because he has 750 videos. So if you don't feel like watching 750 videos, what I would highly encourage you do is just look up like some ICT YouTuber that you can just follow like religiously. I work with this guy named Aham ICT. His channel is also gonna be down in the description below because really this guy has really helped me completely change my trading. I've been trading now for the past 5 years, and it's been what? And since I've been working with him, I've been seeing so much progress in my trades. Last week was my best week ever in trading performance. So it would have been this week because today is Saturday. So all of this week, I placed, I took 5 trades in total. I traded every day. And then from there, I had 4 wins and 1 loss. And then from there, this week, I ended up getting a 4R growth on my account. It's unheard of. Well, actually not 4R because I risked 0.5%. So yeah, what is that, like roughly? I grew my account 2%, which is insane. Because if that was on a prop account, literally would have won the prop account in basically a week and a half. So this week was going great, and it was just because I started to apply these concepts. Now, I was gonna say I'm also gonna put down. He has this and all the stuff I'm gonna be talking about in today's video. If you want to learn this stuff in more detail, go down to the description because I'm gonna have a link to his playlist where essentially he just explains all this stuff in a lot more detail. Because the reality is, you're gonna be watching a video about me talking about each concept for maybe 1 to 2 minutes. So from there, it might not make sense. So if you want to actually go in the nitty gritty, go and subscribe to his YouTube channel. And if you want to talk to me, join the Discord. I'm in there. Obviously, that's his stuff. But I go in there and I always post a bunch of things about just like my trade IDs and things like that. I have nothing to benefit from you guys joining, but I'm telling you, just promise me. I'm promising you. I've been trading this stuff now for a long time, and this is hands down one of the best mentors I've ever had. So go check that out, and I'll see you on the computer now because I'm then going to show you how all this stuff looks.
Alright, so this right here is going to be the relationship between fair value gaps and volume imbalances. So if you don't know what a fair value gap is, this is not the video to learn. But basically, so this is what I've been doing for the longest time. So I used to say, well, this is the wick, and this is the wick. So that means this must be the fair value gap. That's not right, man. That's not right. Because there's something called a volume imbalance. So the volume imbalance, if you look here, I don't know the exact definition, but if you basically look here, you see how the open of this green candle doesn't touch the open, I'm sorry, the close of this green candle. This right here is a volume imbalance. So this is what you would actually make. Oh, you see that? Now, since this is a volume imbalance, that means when we draw our fair value gap, this actually is how you actually would draw the fair value gap. That's insane, right? So the fair value gap and the volume imbalance actually merge together. So this is how you correctly create fair value gap. I'm telling you guys, that little thing was a complete game changer in my trades. Because I don't know if you guys have ever looked at the 22 model, but the 22 model is basically all about taking trades uh, off of a fair value gap. So what would oftentimes happen is there'd be a fair value gap. I wouldn't know that the volume imbalance was supposed to be part of the gap, so I just would never get tagged in the trade because my fair value gap was created incorrectly. And I was saying to myself, I never got tagged in. It's not that I never got tagged in, it's that I just put things in the wrong place. So that is what a volume imbalance. If you want to learn more, go watch Aham's videos. He explains it in way more detail. Or obviously the original guy of all this, and that's ICT. But I would recommend watching his stuff. It's short and straight to the point. If you want to watch 700 videos, be my guest. But anyways, so here's an example in the action market here. So boom, right here, this is a volume imbalance, clear as day. So if you see right here, we have a fair value gap right here, right? So this is how most people would probably create it. We have a volume balance right here, okay? So since that's the volume balance, that actually means that this goes up here. So this fair value gap is actually a lot bigger than what you think it is. So the fair value gap, actually what is this? This is the open is, okay, I'm not gonna try to get super precise right now. Long story short, this is the point. This entire thing right here is a fair value gap. And if you look right here, boom, price goes right into it and wicks. But guess what? If you would have created it the wrong way, that would have never happened. Because look at this here. See that? You're like, oh, price never blah blah blah. But this is what I mean. If you would have done this correctly, because right now we're on the daily chart. Now this minor detail is so important because if you look at this right here on the daily, you see this. As soon as I would have seen this on the daily chart on this day right here, would have been bullish, targeting this liquidity right here, targeting this buy side liquidity. But you would have never caught this trade if you would have done this, if you would create the fair value gap incorrectly. And that's what I'm saying. This stuff is so important, guys. So important. And also to be completely clear here, what you would do here is after this happens on your next day, which would have been on the 19th, you would be bullish. Your bias would be bullish, but you'd be looking to take trades on the lower time frame. So not gonna be taking a trade off the daily chart. But yeah, so here, let me see. Let me see if I can find a bearish example. Boom, right here. Here's another one, clear as day. Volume imbalance, right there. You get the point. And let me see, right here. Boom. Another volume imbalance. This is actually a fair value gap, so this would actually be the gap because there's this little small imbalance right there. Boom. And other stuff is super important. Now, if you want to learn more about this, like I mentioned, just go watch ICT or AHAM ICT's channel. So yeah, that is how the relationship between fair value gaps and volume imbalances. Okay, so now I want to show you guys something called a balanced price range. I just want to show you how dope this is. So basically, a balanced price range is just when you have two fair value gaps that basically overlap. So I just want to look at this right here. So boom. So you have right here, this is actually a volume imbalance. So boom, right there. This is your fair value gap. This is your bearish fair value gap. Then right here, you have a bullish fair value gap. See that? See this dark pink area? Right here, this is where they both overlap. So this becomes the balanced price range. And this level is usually super strong. Like I said, you also need some more stuff to work with this stuff, but just look at this here. So here we obviously inverted the balanced price range, but just notice, look at how much price is going crazy. Giant wick here, wick, wick, wick. We push down below it, we come back into it, push up, go back down, and then we push off of it. This isn't necessarily the cleanest example because I'm not cherry picking this stuff. Like my goal isn't to teach you this stuff, but just to show you what I learned. But just my point is just look at how strong this is. And then even right here too, we have another fair value gap, which is also boom, price holds right here, price bounces off it again, and until at this point we inverted both of them. So my point is these levels are just pretty strong, and this is on a low time frame too. This is on the 5 minute, but on higher time frames these things mean way more. So for example, if you were to draw a balanced price range on, for example, the 4 hour, you could actually formulate a bias and decide how you take a trade on a lower time frame just off that alone. Order blocks are something I've literally been trying to learn now for the past 6 months, and no one ever explained it in a way that I could actually understand until I actually heard it from Aham. So this this is very close to me because these order blocks have been kicking my butt. But I just want to show you what an order block is. So essentially, we have bullish order blocks and bearish order blocks. So a bullish order block is essentially when you have a series of down close candles, and then we then have a close above these candles. So this right here would be a bullish order block because we have the series of down close candles, and then from there we then just drag it out, and this becomes an order block as soon as we close above it. So these are consecutive green candles, so close, close, close. So boom, this candle right here closed above this wick. So this right here becomes the order block. And if you look at right here, you can even see how strong this order block was because essentially, if I can find my thing, price did not go below the mean threshold or the 50% line. Like it didn't close below it. So you can see how strong this was. So obviously this is hindsight. So don't get me wrong, I'm definitely not a genius, but I just want to show you this. Look at how good of a trade entry you could have got off this. So I believe you would have your stop at structure, boom, and then from there, just targeting, 1.5, boom. So this is what I mean. Obviously, this is on a high time frame, it really doesn't make sense, but you can just start to see what you can do with order blocks. So this is an order block right here, and then we have a bearish order block right here. So look, we have an up close candle, but then price closes below it, because this is the close of this candle, and boom. Now this is another thing I want to talk about too, which if you want to know more about, I would highly recommend just visiting ICT's YouTube channel, or like I said, if you don't want to go through all the long videos, just go watch Aham's channel. And basically in there, something I am hearing is what ICT says is that the order block occurs when price closes below the candle. So ICT would consider this to be a order block. I'm sorry, it would be closed below the open. So as soon as this candle closes below this right here, this is what I believe ICT would consider to be the order block because he only counts the bodies. But what I've noticed a lot of times and what I've heard from a lot of people is when they create the order block, they also put the wicks in there because what will happen a lot of times, price will go right into the where the wick is. You'll be able to get tagged in, and then it will just go down. But lots of times you'll end up missing a trade if, for example, you want to take a trade off of the body, which is right here, but price never wicked back into this, so you would never have a trade set up. Obviously, for example, like just to make this more, so okay, so it looked like this, for example. You would take a trade as soon as it touched this. You see what I mean? So that is order blocks. And then from order blocks, we then have breaker blocks. So breaker block is just an inverted order block. So let me see. So we have right here, by the way, I believe this too. Let me see. So boom, one pause it. Okay, boom. So this right here is a breaker block. So if you notice, we have these red candles. There's a series of down close candles, but then we have this bullish candle closing above the wick. Okay, so right here it becomes an order block. Here, still an order block, order block, order block, order block. Still an order block, but right here, when we close below this order block, that's when this becomes a breaker block, and then this is when we be looking for entries off of this point. So this at this point it becomes a breaker, and boom. See what I mean? So a breaker block is just an inverted order block. And then from there we also have mitigation blocks. So then if you look right here in my notes, this is an example of a mitigation block. It's just an order block that fails. So you see how this was originally an order block, but then it didn't even go up. That's why this is a mitigation block. Inversely, I think I might have a bullish example in here. I don't know. So for example, I can't find them. So then we have another mitigation block right here. So you get my point. A mitigation block is just an order block that fails. And then here I'm just going to show you guys basically what my chart currently looks like. I don't want this video to be too long, so I'm not really going to go into a lot of detail. But I just want to show you this here though. So for example, if you look at this right here, this was our new week opening gap. So if I were to go down on the lower time frame, let me see where this starts at. I technically would have to go down on like the 1 minute to be extremely precise. But I just want to just show you this. Okay, so for example, this right here is this is the new week opening gap low. I'm not sure what's going on here. It's whatever, but long story short, you see how this here is the close. Let me see. This right here is the close. So the market closed right here, and then it opened right down here, and then we then have this gap. So this is a new weekly opening gap from 310. So about 20 days ago. But I just want you to just show you on the daily. Look how price just went right back up to that level. Look at this. We have this giant black hole here called a new week opening gap, and price is all the way down here. And look, it filled it in, and then it's pushing back lower. Where is it going to? Uh, I'm actually probably gonna go down to these lows and take out this sell side liquidity. So that's most likely where it's gonna go. And then I want to also show you guys. So we have new opening day gaps. So let me see here. Go down to the boom right here. So on the 1 hour, here's another new day opening gap. Technically got to go on the 15 minute so you can see it better. Really need to go down on the 1 minute, but I'm not doing all that. But if you just look right here, okay, so boom, right here, we have the market technically closes at what is it? 4:59 p.m. New York time. So look right here. This is the close. So this is where it closes, and then this right here is the open, and it opens at 6 o'clock. So this is now the new day opening gap. So on Friday, we were using this for this new week opening. I'm sorry, the new day opening gap from the previous day for setups. So if you look right here, this really isn't the best example, but just look at how strong this level is. And then right here we have this we have this new week opening gap from this week. Look at how price almost taps into this. This isn't the most precise right now in this time frame, but I believe on a higher time frame, you basically see that price taps basically right into this and before pushing lower. So this stuff can just really help you start to formulate a better bias. So then we have macros. Macros are probably hands down one of the most important things there are. So I just want to just show you guys my notes because that'll be easier. But basically, like I mentioned, a macro is just, if you look right here, it's the first and last 10 minutes of each hour. So the macros that we trade the most, like the three most important ones, are 9:50 to 11:10, sorry, to 10:10, 10:50 to 11:10, 1:50 to 2:10. And then basically, I just want to just show you. By the way, this is an important note too. You can look for trade. You can look for a macro setup 5 minutes before the macro or 5 minutes after. So for example, it could be 9:45, 10:15, blah blah blah. You can read it. Then from here, I just want to just show you an example. So this is literally from Aham's free mentorship. But so for example, if you look right here, because this is a really good example. Boom. Okay, so just look at this. Look at how much more price moves during the macro. This is insane. Okay, look, this is just normal time. Right here, we have the 9:45 to 10:15 macro, and just look at how crazy price is. Then right here, we then have nothing. And then from here, we have the other macro, we have the 10:45 to 11:15 macro, and look at how much price moves. Now, to be clear here, macros do not look like this every day, but the majority of the time, relative to the other times of the day, you're going to see the most volatility and the most moves enter the market during macros. This is insane. I'm telling you guys, what I am learning is the only thing that really matters in the algorithm is time. I believe time is the most important thing in the algorithm, which is because it's funny because I have a buddy that ended up winning a prop firm account and knows absolutely nothing at all about trading. The only thing he does is trades macros, and he doesn't even know he's trading macros. It's hilarious, but he's trading a macro, and that's why he was able to win the account. And obviously through also good risk management. But this is my point. Guys, trading is so simple. You can literally flip a coin, have good risk management, and you'll make money. And my friend is proof of that. But literally, look at this. This is beautiful. I'm telling you, go back in your charts and just look at these macros and look at how much price just moves around in these times. Then the last PD array I'm going to be talking about is the 930 fair value gap. Now, I'm not really going to go into this. Like I said, if you want to learn more about any of this stuff, feel free to watch ICT's YouTube channel or just watch Aham's channel. But I just want to just show you guys just the 930 fair value gap. Now, the 930 fair value gap does not always appear at 930. It's just personally what I call it. It's just the fair value gap that appears. That's the first fair value gap to appear after 930. because market opens at 9:30 on indices. So look at this right here. This is crazy. So right here it's 9:31. So as soon as it hits 9:31, we can start looking for FEGs. So we have a fair value gap right here, and then I just want you guys to just look how price respect this. Boom. Okay, so it respects it. Okay, so big reaction here, here. Okay, look. Boom. More reactions. More reactions. Boom. Until we're at right here, which I think is current day. This is current day. Look at look at how important this is. This is crazy. Now, not every day is this gonna work out like this. That's why you guys have to look in your charts, and just look for things. Like you only take a trade when there's a setup, not just because you want to take a trade. You just wait for the market to show you its hand, and if there's an opportunity that matches up with your setup that you have back tested, then you take the trade. You just don't go in here willy-nilly and say, "Hey, I watched this video where this guy explained how, the 930 fair value gap worked in literally 30 seconds, and then I put it in my trades." Don't do that. But I just want to show you guys, though, because I am learning this, and I thought it was insane. It's just how price just is attracted so much to this level right here. So these are a game changer. And then this right here is just something I use, which I'm actually gonna make another video about. Like I talk about this in more detail. But essentially, as you can, I just use this so I can basically figure out what is it that I need to improve upon in my life. So as you can see here, I definitely need to study more accounting. This is probably why I'm struggling in accounting, because I put in 7 hours of studying into the month. This is about, I'm going to say this isn't up to date. I've definitely studied more than this, but that's besides the point. The point is about trading. So that's why you guys are here. So if we look at the trading, you can see that this month isn't over yet, but this month so far, I spent 45 hours watching trading content. From there is 21 hours actually in front of the charts in a live market, and I spent about 28 hours actually doing things like charting. So for example, back testing, things like that. So I would highly recommend everyone to do something like this, just because what gets tracked is a lot easier to reassess. So, for example, if I feel like I'm making no progress on my trading, well, I can then look at my month and figure out, okay, well, this is why. And then even if I were to look at, last month's skill tracker, because as you can tell, I started on the 12th. Last month, I put in about 42 hours. So if I were to have the other half, I'm about the same. I'm usually putting in about 100 hours a month into trading. So it makes perfect sense. And this right here is just my trade journal. I just basically want to show you guys this. Highly recommend you guys do this. This is just my EOD report. So basically, this is exactly the setup I have. And it's pretty cool because I can go back. For example, if we go back to March, just say, let's go to yesterday. So let's see. Let's go back to the first thing. Okay, so topic studied. This is basically just where I was reading about what happened. Blah, blah, blah. Long story short, you can just basically read the stuff, the main takeaways. And then on the next day, I give myself action steps, and yeah. So this is just basically my trading EOD report. Feel free to make a template of this. Highly recommend you do the same.
So with it being the end of March, quarter one is coming to an end. So with that being said, we're about to go into the new quarter. So with that being said, I just want to lay down some on my goals. So next month's goal is literally just going to be to journal all of my trades. This is something I've been really bad at. I really have been struggling with journaling my trades. I just really don't do it, and that's exactly why I ended up buying TradeZilla, or TradeZilla. I always forget what it's called, but basically, so it can do it for me. I know, and it's just so much easier. So got that done. So my goal for next month and also next quarter is just to journal all of my trades, because I have not been doing that like I should be. Then from there is to fill out an end of the day report every day. Every single day, what I do, which I'll show you after this, is I fill out an end of the day report so I can basically see what's going well, what do I need to work on, and what am I going to do tomorrow to make it better. And then from there, it's just really, this is going to be the most important thing of the entire quarter, which is just going to be to back test each playbook. So right now, what a playbook that I'm going to be testing is what happens when I only trade based off of the 930 fair value gap, and then when we wick into it along with higher time frame bias. I'm going to literally do just that and enter off of like an order block, a breaker block, or a fair value gap, and we're going to see how that goes. And then I'm going to literally just test that 100 times along with a bunch of other playbooks, just that way I can figure out, okay, my goal is right now is to have about 10 playbooks in my pocket. And then from there, when I'm on the markets, I'll just be able to whip out whichever one presents itself in the market at that given time. And then from there, the main goal is also going to be just to finish the mentorship with AHAM. It's been going great. My trading has evolved so much since I've been doing it, along with, obviously actually executing the stuff I'm learning. And then just last thing is, if you thought this video was cool, I would highly recommend you to learn this stuff in more detail. Watch ICT's YouTube channel. He's the creator of all this stuff. He's going to be able to go in so much depth. But if you're kind of someone that's in a rush and you just want to learn this stuff as quick as possible, I would still watch ICT stuff because he is the creator of this stuff. But I would highly recommend go check out AHAM's YouTube channel. Seriously, he's been a huge help in my development as a trader, and I really appreciate the guy a lot. So seriously, man, check that out. And by the way, AHAM has a Discord, which I'm in. So if you want to just talk trading with me, or you want to pick his brain, I would highly recommend you to join. It's 100% free. Obviously, there is a paid option, hence why I'm working with him one-on-one. But it's worth every single penny. So yeah, really hope you guys found this video helpful. This is everything I learned in the month of March. And yeah, I will see you on the next one. By the way, last thing too, I'm going to stop uploading the daily trade reviews. Instead, what I'm going to just start to do is, probably at the end of every week, I'm just going to add a trade recap. So it's going to be a video similar to this, but the video will probably be 20 minutes long, and it will be just about all the trades I took during the week. Was my bias, what was the idea behind it, and things like that. So yeah, hope you enjoyed. See you in the next one.